Good afternoon and welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. And joining me at the market site is Adam Sarhan. He's the founder and CEO of 50 Park Investments. Adam, thank you very much. All the way up from Florida.
Thank you for having me.
It's a treat. We only get once a year with you.
It's always a pleasure.
But let's talk about the three most important questions every investor should ask. I think this is a fantastic topic for our audience.
Yeah, it's really important for investors, traders. It doesn't matter what market you're investing in or what asset class you're investing in. There's three things that I like to ask. Number one, when are you going to enter? Number two, when are you going to exit? And number three, how much are you going to risk? So irrespective if you're trading stocks, you're trading bonds, you're trading currencies, you're trading crypto, it doesn't make a difference, right? When are you going to get in? When are you going to get out? And if you're wrong, how much are you going to risk? Those three questions, if you can simplify it, are all that matter to being successful, because the successful investors and traders, intraday, daily, it doesn't make a difference. Long-term investors, that's all that matters. So if you can filter out all the noise and just be at peace with yourself type of a thing and ask yourself, when am I going to get in? If I'm wrong, when am I going to get out? And how much am I going to risk? You'll do extremely well over the long term.
Well, this brings me to my second question, and I would imagine out of those three things, exiting the trade is probably the most difficult for traders and investors to do, because there are some common psychological pitfalls that we've all been there and we've all done that. So what are your thoughts on that?
Sure. So I've gone back and studied every major bull and bear market in history, and you can study I've studied every bubble too, going back to the tulips, right, in Hone. And there's a few things that I want to talk about. Number one, the assets have changed. Number two, the centuries have changed. Number three, the people, where the bubbles are created, in the West, in the East, in the Far East, it doesn't make a difference. They've been all over the world. Everything's changed, but there's one common denominator. That common denominator is fear and greed, your psychology. Human nature is the one constant. So if you walk in, what does that mean in layman's terms, right? So if I walk into a crowded theater and I yell fire, what happens? Anywhere in the world, people are going to run, right? If you're wealthy, if you're tall, short, fat, skinny, it doesn't matter. Your religion, your race, your creed, it doesn't make a difference, right? Smart, it doesn't make intelligent, non-intelligent, it doesn't make a difference. So the same thing with markets. When you look at it from that point of view, that psychology is really, really important. So it gives you a lot of clarity, because then there's two components of psychological analysis. So fundamental and technical analysis. So I developed a third term called psychological analysis for investing and trading. So when you branch it down, you ask yourself, what does that mean? There's two components. One is your own psyche, and two is the market psychology, because it shifts, it evolves, just like states. Like at night you're tired, in the morning you're awake, and you have lulls during the day. The same thing with markets. So it comes and goes in waves. And if you understand the psychology, what are the two parts that are really important? Fear and greed.
Right.
So Warren Buffett says it best. He goes, you want to be greedy when others are fearful, and fearful when others are greedy. Well, what does that mean in how do you apply that, right? So if you buy something, let's just say you buy something at 100, and it goes down to 95, you're hoping, you're greedy, hoping it's going to get back to 100 so you can get out for break even, right? But what you should be doing is fearful that it's going to go down to 50, right? The average investor psyche. So it's counterintuitive. And conversely, when you buy it at 100, it goes to 101 or 102, you sell it because you're fearful that the profits are going to be erased and it's going to go back down, you're going to lose money. This is just the average person's psychology, right? So instead, when it goes to 101, 102, that's when you should be greedy instead of fearful, and let it go to 110 or 120 or 150 to 200 to 300. That's how you make big money, by switching the components.
Right. Well, I mean, everyone's risk parameters are different as well. So your trading plan might be the same as my trading plan, and I think that's something that's really important for investors to recognize, which brings me to the next question: how to trade the news. You hear so many, you hear people on TV, like I saw this kind of options flow, or I love this stock, or you have a pundit on there and it runs shares, up or down depending if they're long or short. That also impacts it as well.
Yeah, so trading the news is really, really important. So everyone, when you look at your time frame, is really important. There's short, intermediate, and long term. That's the average trader or investor's time frame, right? So irrespective of your time frame, there's news that unfolds in all of those time frames. So in today's day and age, where there's so much news all the time, you have to ask yourself, are you trading, what is your time frame? If you're an intermediate term trader who makes decisions on a weekly or monthly basis, the intraday news, unless if it's a big data point, shouldn't matter that much. But if you're an intraday day trader, that obviously matters. So you have to keep your finger on the pulse of what's happening in the news. So the way that I trade the news is I ask myself, what is the actual impact? It's not the news that matters, it's how the market reacts to the news. Because that's all that matters here. So what happens is I sit back and say, okay, there's only three things the market can do. Any market, any stock, it doesn't make a difference. It can go up after you buy it, it can go down, or it can go sideways. Or the same thing for shorting, right? It goes up, down, or sideways. That's all it can do. So it's oversimplistic, but let's say you have an earnings report. What happens to the stock? Does it go up, down, or sideways? Let's say you have an inflation number, economic data point, central bank, whatever that news point, that data point is, I always ask myself, what is the reaction? Because that shows me what the marketplace, what everybody on aggregate is doing. Are they bullish, are they bearish on that data point, on that news event that just came out?
All right, well, let's wrap it up with this. You can't obviously predict market action. If we all could, we'd be living on the island of Jill or Adam, right?
Right.
But how do you anticipate these types of movements?
Sure. So the way that a lot of people give predictions, hey, where's the market going to be a year from now, 2 years from now, 5 years from now? The future, by definition, on Wall Street and outside of Wall Street is unknown, right? So trying to predict the future, in my humble opinion, isn't the greatest thing in the world. So instead of predicting that something's going to happen, what I do is I anticipate. So some people react to the news or react to the market. Oh, this just happened, I'm going to go do that. The problem is you're always a step behind. So with the anticipation, you can start, when you study patterns and you study market behavior and the psychology of it, you go into the room, yell fire. There's certain type of patterns that show up, and they're recurring patterns. So when I anticipate something's going to happen, go up, down, or sideways, I have a plan for it, and I plan ahead. So I only can get in, get out, and how much I'm going to risk, right? So if I'm in, what am I going to do if it goes down? What am I going to do if it goes up? Am I going to buy more, or am I going to get out if I'm long, or short the opposite, right? So it all depends on my anticipation. So if I leave in the morning to go to work, and I rush hour traffic, I know I'm going to be in traffic. So I'm sitting in traffic. Am I going to sit there and be upset and be frustrated? No, because I'm anticipating it's going to happen, right? So it's the same thing here. So there's only 3 things that can happen. Have a plan for each one. Does it go up, it goes down, or does it go sideways? Anticipate that in advance so you're not playing rear view mirror looking behind you and reacting all the time, and you're not predicting because no one knows what's going to happen.
All right. Well, thank you very much for joining us at MarketSite. And traders, as always, thank you for joining me for Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq.